Hello and welcome to the latest in our Now and Next series of webinars in which we explore key issues affecting businesses, affecting you, our clients. In this webinar, we're going to look at the economic climate, the international economic climate at trade, investing and funding. My name is Matthew Kirk. I'm International Affairs Advisor at Squire Patton Boggs. And I'm delighted to be joined for this short webinar by Shanella Rajanayagam, who is a trade economist with HSBC. Welcome, Shanella. And by my colleagues, Paula Laird, who leads the Squire's Europe and Middle East banking practice, and Jose Maria Vinales, Pepe Vinales, who leads the European International Trade and Sanctions practice at Squires. So with that introduction, let me kick off the discussion by coming, Shanella, to you first. There's a great deal of discussion in the media and in academic articles about deglobalization, about how production is being reshored, decoupling of the relationship with China, and China as the manufacturing hub of the world. How much of this do we actually see in the statistics? What do the numbers tell us about what's really happening in global trade?
Yeah, thank you, Matthew, and thank you for having me. We have done a bit of work on this, on deglobalization specifically, but also on the trends of nearshoring and reshoring. So interestingly, when you look at things like the real exports to GDP ratio, that's actually flatlined, if not ticked down a little bit since the global financial crisis. So it's very clear that those decades of hyperglobalization, from the 1990s through to just before the GFC, that's largely behind us. And so very clearly, there's been this push by governments to de-risk from China, to reduce reliance on single foreign suppliers as well. And we start to see a little bit of that bearing out in the trade data. So one example is that, last year, Mexico actually surpassed China to become the US's top import source. And that was the first time that the US has imported more from Mexico than from China since the early 2000s. And it's very clear in some of the product data as well that China is losing import market share in the US and in Europe as well. So, for example, it's lost import market share in the US in phones, in footwear to the likes of Vietnam. A similar picture in the EU for certain apparel, with it losing market share to the likes of Turkey and Bangladesh. So it's very clear that some of this reconfiguration is starting to happen. But what is also interesting is that if you look at Chinese export data, so it's exports to Vietnam, to Malaysia, to India, that's actually increased by 100%, if not more, since 2016. So very clearly, there's some degree of trade diversion going on, perhaps to circumvent some of these new tariffs, but also perhaps reflecting China's own movement up value chains. But that's all to say that these shifts are starting to happen. When we did the nearshoring and reshoring work, the upshot of that research was that these trends are still at a relatively early stage, and we think it will continue to happen, but it will be concentrated in a select few sectors. So things like electric vehicles and chips. And I suppose the last point I'd make on this question is really that China still plays a pretty important role in global trade. So by our calculations, at least 70 economies still consider China their top import source. So certainly its role is reconfiguring, but it's also an important investor overseas as well. And so when we think about how supply chains will continue to reconfigure going forward, I think China will still continue to play an important role in that.
Thank you very much, Shanella. And Pepe, could I turn to you? Shanella mentioned there some of the measures that governments are taking which are affecting global trade, indeed in some respects constraining it. Some of those are driven by geopolitics, sanctions, export controls, that kind of thing. Some are looking more protectionist, such as tariffs, and then you have increasingly controls on investment as well, which are more about protecting national security. What trends do you see in the ways in which governments are intervening and effectively managing international trade?
Thank you, Matthew, and thank you for making this happen and for having me on board. Yeah, I mean the wave we're seeing right now is a restrictive and protectionist wave in different ways, in different forms. On the restrictive side, we see obviously sanctions and export controls, which are driven by geopolitical events, sanctions against Russia, against Belarus, but as well the increase of the items and goods that are subject either to export controls in the United States or to dual use in the European Union has also increased. Right now, for the UK and for the European Union, we are more on the enforcement side of sanctions and export controls, putting in place the mechanisms, ideating, designing the mechanisms to be able to enforce the already existing sanctions, rather than in the mood of imposing new sanctions. There are as well some European Union member states, and this is significant because they have stepped out from the European Union harmonized framework. So, for example, Poland has imposed its own sanctions against Russia, or the Netherlands has entered into as well further export controls on semiconductor technology. So that means that if you're a Chinese buyer, you can go to Germany and there is no need to get a special license to buy semiconductor technology. But if you go to the Netherlands, you will need to go to the Dutch authorities and get that prior approval and license. Obviously, the European Union has an important push from the United States to increase our export controls, in a way to speak, or our authorizations prior request when exporting specific goods and items in strategic sectors as the semiconductors. And as well, the FDI measures. I mean, the foreign investment into the European Union went down from 7.1 billion euros in 2022 down to 6.8 billion in 2023, which put the foreign direct investments in the European Union at the level of 2010. And this is due to the different FDI mechanisms in place in different countries of the European Union, where there is an intention to harmonize so that you get the exact triggering events when going through different or the same type of foreign direct investment in the European Union. And then you have the protectionist measures. I think you mentioned as well tariffs, which are trade defense measures, specifically in the form of countervailing duties. And we have seen that last Friday, the European Union Council approved by a majority, not an unanimous consent, as you can imagine, because Germany and Hungary, among other countries, opposed to these measures, to increase the already existing 10% tariff on battery electric vehicles from China. So right now, the new increase is 35.3%. This has been approved, so now it's going to the European Union Commission to issue the relevant regulations. And then on the soft side of protection measures, we see as well some European Union regulation on some strategic sectors, as for example, the European Chips Act, where there is a clear intention that the European Union is self-sufficient and is capable of producing and manufacturing 20% of the world supply of chips by 2030. And this requires a massive investment of around 43 billion euros that would come from public and private funding sources to be able to reach this threshold. Or other regulations, as for example, the carbon border adjustment mechanisms, which taxes high carbon import. So if we had to summarize in a sentence what's going on at a European Union level, we can use what President von der Leyen, President of the European Union Commission, wrote in a letter to the new Trade Commissioner, which is, I encourage you to put in place a new economic security doctrine. And this means that for non-European Union entities, this means further trade defense instruments.
Thank you, Pepe. Chanella, can I come back to you again? I mean, obviously, what Pepe has described is a wide range of things that governments are doing. What's the economic impact of them overall? How do you see that? And perhaps particularly looking forward to the US elections early next month. It seems to me that either result is going to have a strong sort of America first element to it. If it's President Trump, it'll be, from what he said, through tariffs. If it's President Harris, the continuation of the Biden administration massive subsidization approach through the Inflation Reduction Act and so forth. Do these pose risks to the global economy, do you think?
Yeah, thanks, Matthew. And that really is the big question at the moment. How do we actually quantify this in some meaningful way? I will say, when it comes to trade protectionism, it's almost as if there are new protectionist actions that are being announced that are quite different to what protectionism looked like, a decade or so ago, because when we look at things like industrial subsidies, they actually now distort a greater share of global trade, so about 60% compared to tariffs, which is about 25%. And tariffs have historically been the trade protectionism instrument. So also with things like the lack of appeals court at the World Trade Organization, with that not really functioning, it's almost as if there isn't really much in the way of recourse. So governments, economies are almost free to levy as much protectionism as they want. And this is how we risk getting into more of a tit for tat trade, or indeed tariff war. And when it comes to the US election specifically, I agree with how you almost framed that question. Our view certainly is that protectionism and US trade policy uncertainty will certainly continue regardless of the outcome. It's just whether there will be this massive escalation in trade tensions if Mr. Trump is re-elected and he levies his universal baseline tariff plus a 60% tariff on imports from China, or whether it will be more of the status quo under Kamala Harris if she wins. But even under that scenario, we do think that there will still be a continuation of protectionism, because if you look at the actions by the current administration, they've kept in place the bulk of the previous Trump administration's tariffs. They've even gone so far as to increase tariffs further on about $18 billion worth of imports from China. They've gone further in terms of tech export controls as well. And they've really tried to lean on allies like the Netherlands, Japan, Mexico to almost restrict their trade with China. So we think that's more of what we would see under a potential Harris presidency. In terms of the impact of potentially the new tariffs, that would certainly have macro impacts, but also potentially inflationary consequences as well. We actually did a very back of the envelope rough calculation and estimate that the new tariffs, if implemented, so the baseline plus the 60%, that could push up US consumer prices by about 2%. And that very much is an upper bound, because as we saw last time, the new tariffs were almost shouldered entirely by US importers, and then a very little bit of that actually passed through into consumer prices. So the true impact really will depend on the pass-through, whether there's any trade diversion, or indeed how any of these future tariffs will actually be structured.
Thank you, Chanella. Paula, can we come to you? And this is a picture of global trade going through quite a substantial government-driven transition. How are the financial markets viewing this? Is it a cause for concern, or is there still good confidence in the financial markets?
I'm trying very hard, Matthew, not to groan at this point, because I think it's got to be the most difficult year to predict, and things are changing month to month as data comes out and makes markets ever more jumpy. So just as we thought that central banks had started to ease monetary policy and we were getting on top of inflation, we hear this morning that borrowing costs by reference to 10-year gilts have increased by 0.4 percentage points. So is that because markets have reacted to the Chancellor threatening to relax borrowing rules to fund increased investment, and they're perhaps still suffering PTSD from the mini budget that Liz Truss launched, or is it wider than that? And I think you've got to look at a more global picture. Certainly in the US, the data, the better than expected jobs data in September has led to the fact that markets are thinking, is inflation going to rear its head again? Is interest rate cutting going to be much more slow than we'd originally thought? So I think what's very certain is there's a continued picture of uncertainty and volatility, and most definitely, and this is not rocket science, is it, but the era of cheap money has almost certainly come to an end. And that leaves lenders and borrowers looking at this picture and having to adapt. I do think we're going through quite a big change in the market. They've got to adapt to higher long-term interest rates. What will the new normal look like? Nobody really knows that yet. Shanana mentioned increased inflation caused by supply chain friction. That is as evident as it ever was. More regulation in the sense of Basel III, Basel IV coming in. And that has led to banks being definitely more cautious and imposing more stringent credit conditions. The direct lending market has obviously filled that gap and has increased exponentially post-financial crisis. But I think there is a bifurcated market, to answer your question. The resurgence of the public markets at the beginning of the year enabled good quality credits to access cheaper funding, actually, because there's lots of competition for a few high quality assets. I think we're very much seeing that picture. And in turn, lenders are having to look more to the mid-market for opportunities, but the quality there is more variable. There's more risk associated with that. Deloitte reports that processes are taking longer to complete, and we're certainly seeing, anecdotally, evidence of that. Processes stretched out by perhaps, a couple of months, which makes all the difference to a company that's looking for liquidity. And by adapting, what do I mean by that? I think corporates and sponsors have got to look for more creative solutions in their capital structures. So perhaps looking at PIK, perhaps looking at second lien loans to increase liquidity. We've seen actually some tie-ups with some of the banks with direct lenders so that they can look at their capital structure more creatively. And against this, there's a backdrop of caution among corporates who are perhaps putting anything that's event-driven, any event-driven financing on hold because there's no real certainty. I mean, we've waited since the new government was elected. We've waited 16 weeks for the budget, which is unprecedented. It's usually much closer to the election of the government that we would see a budget being implemented. So again, that's caused delay. So I think, the rest of the year is looking, it's just holding on, I think, and probably looking to 2025 for us to be able to predict with more certainty what's going to happen in the markets.
Thank you, Paula. Paula mentioned there the inflation risk. What's your view of the trend in inflation? Have the central banks successfully squeezed it out, or do you think there's more pressure there? And what does that mean for interest rates?
Yeah, so the major central banks have started cutting interest rates. The Fed, the ECB, the Bank of England. And actually, on the back of the Fed's 50 basis points cut recently, a number of other central banks have either started or they're going to accelerate their easing plans as well. I mean, in terms of our forecast, we definitely see the easing cycle continuing through this year and into 2025 as well. For example, our current forecast for the Bank of England is that we'll see one more cut this year in November, and then 25 basis points of cuts every meeting next year until December, which should take bank rate to around 2.75%, a level that we think should be neutral. The risk, though, of course, is that there is a lot of uncertainty in the system at the moment. Oil prices have spiked up again. Shipping costs, even though they're coming down, they still remain elevated. And of course, the risk from tariffs as well, which I mentioned previously. And so I think the point to make here is, even though the easing cycles have commenced, we still expect the rates to settle at a higher level than they were in the period immediately after the GFC. So we're not going back down to really, really low levels, but we still expect the easing to continue.
Thank you, Janella. So no more free money is the lesson of that. Pepe, how are we seeing our clients adjusting to this sort of shifting geopolitical context? What's changing in trading patterns, and particularly supply chains, market access, that kind of thing?
Yeah, I mean, we're seeing a clear shift and a clear interest by companies to change their strategies. So, for example, what we see the most is companies diversifying their supply chains. So geopolitical risk is the main aspect, which is taken into account when making these decisions. And then they have to opt either for a nearshoring strategy or a friend-shoring strategy. It seems that, and according to the European Central Bank statistics, nearshoring is more popular among European companies than friendly shoring. So around 28% of the firms apparently have nearshored in the past 5 years. And 49% said in this poll that they were expected to do so in the next 5 years. While companies friend-shoring were only about 22%, and the ones expecting to adopt this type of strategy in the next 5 years was only 11%. So this is giving us as well a clear image of where the companies go and what is the type of risk they want to tackle. As well, we see companies trying to reassess their market access strategies. So, for example, we see a lot of clients from the European Union relocating their production, for example, in Mexico, to be able to benefit of the USMCA treaty and avoid trade barriers, geopolitical risks, or any other potential negative aspect in trade. As well, we see many companies, both in the European Union and out of the European Union, that trade with the European Union, trying to be first movers, and trying to take the opportunity to benefit of all these sustainable and ESG regulation, which is now either recently passed or in the pipeline or in the process of being agreed at a European Union level. So the regulation on deforestation, the due diligence and sustainable directive, those are just some examples of regulation that is going to be applied with the European Union entities in the near future, and that is going to have a great impact on as well on determining the supply chain and the strategies of the companies when relocating and selling to their existing markets. And finally, we have a lot of companies that are doing their best to adapt to the new existing sanctions, navigate sanctions, and still do business with countries that are under sanctions, but in a very secure way and making sure they comply with all applicable sanctions. The Russian sanctions of the European Union against Russia after the full-scale invasion in 2022 are unprecedented. And Russia was one of the main trade commercial partners with the European Union. So that means that the restrictions, the prohibitions, the bans, sanctions against Russia has caused a boomerang effect in many European companies that have to find new supply chains, new suppliers, or even new clients. So they have to look in other markets for what has been caused in the Russian market.
Thank you very much, Pepe. Shanella, both the UK and the EU, if you look back at the years sort of from 2008, from the financial crisis onwards, have underperformed relative to other major markets in terms of growth. Clearly, we have a new government in the UK for whom growth is a central priority. I think it's a central priority for virtually every government in Europe. Do you think that governments in general have got the right prescription to engender more growth? Do we see improvement coming, or is there more work to do?
Yeah, so based on our outlook, it's a bit more of a mixed bag for Europe, because at the moment, the core economies in Europe, so Germany, France, they still remain pretty soft. So Germany's manufacturing sector, for example, is still really weak. And actually looking at some of the leading indicators like the new industrial orders, which was out recently, it suggested that weakness is set to continue. France clearly has, a bit of a fragile political backdrop. The new government has limited support in the National Assembly, which could really constrain its ability to actually push through or pass, any bold actions. And then on the consumer side in Europe, it's been quite interesting because household spending rates are very, very high. And perhaps you might think, as interest rates start to come down, maybe that would lend some support to consumer spending. But at the moment, it has been a bit of a weak picture for household spending, particularly in Italy and Germany as well. So that's almost, the bad news, because some of these economies, especially Germany, being hit with both structural and cyclical issues. The good news, though, is that there is a bit of a divergence in expectations of companies in the services industry versus the manufacturing industry. So it's not necessarily the case that the malaise in the manufacturing sector would spill over into the services sector. And then, of course, if you look at some of the European economies outside of the core markets, growth is actually holding up reasonably well. So Greece's growth story is actually going pretty strong, as is growth in Portugal and Ireland as well. In the UK, it's a bit more positive as well, although there was a bit of a come down in near-term momentum recently. But certainly our view is that, the monetary easing combined with dwelling investment should help to buoy growth through the second half of next year and into 2026. The key flashpoint, of course, for the UK is the budget on the 30th of this month. We are certainly not expecting an austerity budget, but it's unlikely to be a splurge either. So we think, some combination of tax rises, combined with borrowing increases and spending cuts. So a lot of uncertainty there. Certainly on the trade side, the government has announced intentions to, reset relations with the European Union, which should also help to support the growth agenda. But our view on that is that, negotiations could really take some time, and some key compromises will have to be made.
Paula, investment is obviously key to growth. When you look at the financial markets, is there capital sort of looking around for good things to invest in, on the hunt, as it were, or do projects sort of have to scrabble to find the cash more? What's the general state of liquidity at the moment?
I think the answer to that, Matthew, is it very much depends. Good credits will always attract capital. We've seen that although the banks have retrenched and credit conditions are getting tougher, we've seen the growth of the private debt market, and there is a lot of liquidity looking for a home. I would say in terms of how businesses position themselves, impact investing is definitely a growth area for lenders. So looking at the whole ESG landscape and preparing a business to comply with all those different conditions. We're seeing, very specific criteria put into loan documents now, specific KPIs which can reduce funding, can reduce interest rates for borrowers if they comply with certain criteria. So that's very much becoming more evident year on year. And I think the other thing that businesses can do is to put themselves in the best possible shape to attract capital, to look at all of these headwinds facing them, looking at the geopolitical situation, looking at the isolationist policies of governments, so that their supply chain friction, as much as they can have control over that, is they're cutting costs out of it as much as possible, so that they're in the best shape to attract capital and investment. I think it is very much bifurcated as well by sectors. So we're seeing sort of more investment in areas like TMT, business services, as Shonella mentioned, healthcare, life sciences, financial services. Perhaps retail, manufacturing is tougher and less predictable to see where some of those sectors are going.
Thank you very much, Paula. Well, we've gone just over our allotted half hour. I perhaps could come to each of you for a very quick question to wrap up. And the question is, what should be top of mind when thinking about risks in the global economy at the moment? And perhaps, Shonella, you could kick off with that one.
Yeah, I think scenario planning is a good one, because we could be in a world where all the forecasts I mentioned today, they come exactly right, but I very much doubt it. There's a lot of uncertainty in the system, so I think really planning out the different scenarios and how to navigate that uncertainty would be quite helpful.
And Pepe, top of mind in your world?
Top of mind, but I think the U.S. elections can be a game changer in many ways. The policy on China, the approach to the Russia-Ukrainian conflict, as well the position of the European Union towards Iran, or even the approach of the United States to Venezuela may change depending on the color of the new government, and as well what is going on right now and the potential escalation in the Middle East as well can be as well considered as on top of the desks of the board of directors, and the route of the Red Sea, which normally transports around 10% of the world production of oil and 8% of the world production of LNG. So the Houthis in that part of the world and the conflict with Israel can cause a serious damage to the trade, the costs, the expenses, the routes. And as well, the price of the crude. I think it was last week, the crude oil prices rose nearly 9%, and it seems that this war going on in the region is far from an end.
Absolutely, plenty of things that could drive spikes in energy prices or disruption to logistics and trade. And Paula, for you, top of mind in the financial world?
I think sort of continued supply chain friction, which introduces costs for businesses and takes them away from the main purpose of their business. So these are unnecessary costs. So trying to control those as much as possible, and as I said before, putting your business in the best shape to enable it to raise funding. I think that's going to be critical, because there's so much about the world economy you can't control. So where control can be exercised, I think that's really important. Embracing things like technology, AI, and so on, and looking at those and how they will drive down costs in a business will set businesses up well to secure capital.
Super. Well, thank you very much to Shanella and Paula and Pepe, and thank you to you for listening. And please have a good and safe day. Thank you all very much indeed.